Hello and welcome to yet another episode of Experts View section of Horizon, the Videozine of JMfinancial Services Limited. And we've got an amazing guest today, an industry veteran who's been into fund management side, was a CIO at one point in time, and is now MD and CEO at JMfinancial Mutual Fund, Mr. Amitabh Mohanty. Thank you, sir, for your time, and we really are looking forward to this particular interaction to get your insights on the not so easy subject of the balance sheets of central banks. Because as we meet a lot of investors in the market, as our partners meet various investors, more or less good number of people are familiar with corporate balance sheet, or at least they've heard about that. But central bank balance sheets are something that is not in the common discussion. So I would request you to explain what are the primary differences between a corporate balance sheet and a central bank balance sheet, or there are no differences at all, whatever.
So thank you, Amit, for having me on this show, and your kind words, of course. So the basic difference between a corporate balance sheet and a central bank balance sheet is that the central bank can print money.
Right.
Okay. So that has a lot of implications for the overall macroeconomic conditions of the market. And what we have seen in the last 3-4 years since COVID actually gives a very, very good example of what happens when different central banks pursue different policies of expanding their balance sheets. And that leads to second order problems of inflation, that leads to second order problems of fisc going out of shape, and therefore the basic issue is that when central banks expand their balance sheet, in most cases the domestic currency supply goes up.
Correct.
Okay. So sometimes central banks do sterilize that by doing reverse repos or doing OMO sales. So all those things to sterilize the excess money that has been created. But broadly, you will see that the first order issue of central bank expanding or contracting its balance sheet is on the domestic liquidity front. So that I would say that a corporate or even the government, for example, cannot print money. There's only one entity which can print money, which is the central bank. So that's the basic difference, that a central bank can either withdraw currency or create currency, and that's the biggest difference between a central bank balance sheet and a corporate balance sheet.
Wow. So you use this term called expansion of the central bank balance sheet, and some of the reports that I've read indicate that because the central bank's balance sheet is expanding, that's a problem. Now, when you look at a company, a good profit-making company, as the profits grow, the balance sheet expands, and we call that company a healthy company. But when a central bank's balance sheet expands, some people get worried. Why does that happen?
So it's the same as a corporate balance sheet. The balance sheet growth has to be in sync with the inherent growth of the entity. So if a corporate balance sheet, for example, grows too fast, which is much more than the growth of the company, that means a lot of debt and other stuff has been taken on its books, right? Similarly, a central bank balance sheet, if it grows too fast with respect to the GDP growth, etc., then it creates a same kind of a problem, which is that this balance sheet is mainly creating debt in the overall system. Okay. So it's actually not too different. Because we have seen in the corporate world in India where a lot of corporates took excessive debt, grew their balance sheets too fast, and that led to a collapse later on, right? Same with central banks, and we have seen the kind of balance sheet growth that have happened. We have been lucky. RBI has taken a very different route, but the big elephant in the room for the US and other developed countries of the world is that the expansion in balance sheet which took place during COVID and the immediate aftermath, how to unwind it. And that's why I would say that yes, it is a definite cause for worry, but it's not the expansion in itself, but the rate or the pace at which it has expanded compared to the overall growth of the economy.
Okay. And so it's expansion at a much faster pace compared to the natural growth of the economy, if I may use that word.
Yes.
If that's a problem, how about contraction of the balance sheet of a central bank?
See that is what Amit, the world over central banks are grappling with. That's the big elephant in the room, as I said, is for a global economy which is so much financed by central bank balance sheet expansion. It's like a economy on steroids, right? What happens if you reduce it? What is the pace at which you reduce it? Do you reduce it too fast, contract the balance sheet too fast, and then there will be implications on the domestic liquidity, it will have implications on cost of credit, it can also impact the credit growth in the economy. Yeah. So the point is that's a very delicate balance that central banks have to do, that yes, you cannot keep on expanding beyond a point, you stabilize it, you start contracting, but then you have to be very clear that what is the pace of contraction. And if you have seen the last Fed meeting, a reason why the markets went up after the Fed meeting was that the Fed reduced the pace of reduction of the balance sheet. Okay, so that people took as a positive that the tightening or the quantitative tightening, QT as they call it, is not going to be as severe as what they expected. So it's a very delicate balancing act where central banks look to growing is easy, almost always, right? The pans come later in terms of higher inflation, and that's why sometime in 22 and maybe early 23 we saw inflation go out of control in the developed world. In some certain areas, the inflation numbers were like third world inflation numbers, right? So this was all a consequence of the pace of growth of balance sheet during the COVID times, right? And then everyone started to pull back, but pulling back is always tougher. It's like if you take the analogy of a person who is addicted to drugs, it's like how do you withdraw it, and the person goes through cold turkey, and that's always a very tough process, and how you handle it, and that's what governments are doing, central banks are doing all over the world. I think India that way is much better placed.
So, like, a brilliant example or brilliant analogy that you used of somebody who's on drugs, because I was thinking in my mind that this was something like economy on steroids, and it was growing at a much faster pace, and suddenly there are withdrawal symptoms the moment somebody starts to withdraw.
No, not only that, Amit. The problem is the world over economies have gotten so used to debt. Now every incremental addition of debt is not having the same impact on growth.
Right. That's another problem.
Okay, so I always compare it to a agricultural analogy that if you use fertilizers beyond a point, you can keep adding fertilizers, but the productivity growth starts tapering off, right? So that's what's happening in the world, that with so much of liquidity also, everyone is worried about some of the developed countries' growth slowing. It's good that US has been resilient, but if you look at the Eurozone, etc., even with so much debt plowed in, growth's really not taken off. And that is actually a worrisome factor. And that's where central banks are saying that if there is no growth, how does this repayment capacity come down to repay this external, this huge debt that central banks have. Also, it has a very interesting connotation. If your growth is not very high and you have got a large amount of nominal debt outstanding, central banks willy-nilly will have to tolerate a higher inflation.
Right.
Because your inflation plus your real growth, your nominal growth, and that has to be maintained at a high level, and that is one way of eating into your debt pile. Okay, so the tolerance for higher inflation is willy-nilly thrust on central banks to try and eat into this pile of debt, and that's what is again a thing which is very, very worrisome for the future. How it will play out, we don't know, but yes, that's something we do keep an eye out for.
Super, super. This amazing insight because lot of times people, when they don't look at what the central banks are doing, they miss out on some much bigger points, more important and critical points than looking at some of the minor micro factors. So now let's look at the response to the recent Fed meeting, FOMC meeting, that markets went up. Right? So expanding balance sheets or contracting balance sheets, what are the potential impacts on the financial markets, be it equity, debt or currency markets?
So see, what happens is when your balance sheets are expanding, it obviously leads to higher inflation. It leads to some kind of a debt overhang increasing, and more important, it leads to, at a certain level, a devaluation of the currency. Okay, now if all the central banks are doing it, every currency is devaluing against each other, right? So they are relatively both come down.
Right.
Okay, so what does it devalue against? It devalues against real assets like land, like gold, like commodities. So that's one reason why you see when balance sheets expand, a lot of liquidity is this thing, commodity prices start going up. Gold prices start going up. Okay, so those are the implications from a portfolio perspective, from an asset perspective, that there will be an overall inflation of the price of assets. That's why you see when central banks go crazy, like what has happened in the last couple of years or 2-3 years back, assets like which have a limited supply, like crypto, they all went through the roof because people said that okay, a fiat currency can be printed out of its value,
right,
but something which has a limited supply like gold or crypto, they start appreciating because a lot of people say that okay, I might as well hold this rather than dollars. One way to play it is to be in the equity asset class, because normally equities do very well in a higher inflation period, and that's a good inflation hedge. One of the worst things that you can do in a higher inflation this thing is to go to debt. Okay, that gets, the value gets inflated again, right? So those are the things one have to take care from an asset allocation perspective, etc., when we see this kind of balance sheet expansion.
Yeah. And you highlighted the role of RBI in the discussion a couple of times, that we've been fortunate that RBI did not go as crazy as some of the other central banks. So as an Indian investor, should one worry about what is happening with US Fed or Bank of Japan or European Central Bank or whatever other central banks are doing? Should an Indian investor worry, or is RBI action enough to watch?
So I'll tell you, it's not only RBI. If you see, India is one of those rare economies where the government and RBI are in sync. Okay, the government took care of the fiscal policy, RBI took care of the monetary policy, and both have been not profligate. If you look at the kind of liquidity created by RBI during COVID, they were given in terms of loans or in terms of facilities with a sunset clause.
Right.
After 2 years, after 3 years, it comes to an end, it comes back.
Or there was a moratorium to
so the point is everything. They didn't go for unlimited printing that you put it, you don't know how to take it back. So in India, those facilities, as the economy revived and stabilized, those things closed.
Right.
Okay, so they closed, and therefore the creation was not permanent and was not huge. Similarly, if you see, our government has been very, very fiscally responsible. So it allowed RBI not to expand its balance sheet to fund the fiscal debt.
Right.
In US, the Fed cannot do beyond a point because there's a huge fisc going out of shape, which they have to also support in a sense. Okay, so I always say that US, while it's doing well, but we don't know for how long, it's like you are in a vehicle, there's one guy putting the foot down on the throttle, and the other guys put down a huge thing on the brakes. Okay, so a lot of smoke is generated, the vehicle's going nowhere. But we are lucky as a global thing that the US economy is showing resilience, but how much of this resilience is fueled through debt, At the individual level, at the corporate level, at the government level, that's a different question altogether. From an Indian investor perspective, yes, it does impact capital flows. We have seen several times during the past few quarters FII selling. Okay, and part of their reason is that they feel the QT is actually bringing down the dollar supply, etc. So part of the reason, obviously part of the reason is valuations, etc. But part of the reason is that it's higher for longer now in the US. The cuts that were being anticipated are not on the table. So the cost of money is going to stay high, and therefore from an offshore investor, the risk-free return is going to be elevated, and that impacts valuations and their flows. And from an Indian perspective, if a lot of FI selling is going to happen, that at the margin will definitely have an impact on the markets. And that's what we have been saying. Domestic investors in India have been very resilient through mutual funds and direct equity. So that has mitigated the blow. Yes. But there has been a significant outflow, and it is continuing. So those are the things one needs to just be very careful of, and the valuations where they are, maybe a note of caution should be there with all these things happening on the global front.
So now, inflation creates a problem for debt. Valuations and liquidity outflow may create a problem for equity. In such a situation, and given what the central banks are doing across the globe, what should an Indian investor do to create a portfolio that is reasonably resilient?
See, it's a tough ask because gold has gone up, a lot of commodities have gone up, but I think people need to just diversify. And when I say diversify, it's not only fixed income and equity. I think people should build a segment of real assets in their portfolio. And today it is easier to build a portfolio of gold, not only through physical gold, but through the sovereign gold bonds, etc. ETFs. So there are a lot of financial products through which you can lock yourself to gold. May not be residential flats or something like that, but I think land is if wherever possible, can form some part of it. And people should play the equity cycle. Okay, and yes, valuations are challenging, etc. So the point is either use a STP or a SIP kind of this thing. Keep some amount of your powder dry. That maybe if there is a correction, like what we have been seeing in the past few days, etc. Maybe you start deploying some of this thing. So I think equity still, especially in an era of reasonably high inflation, etc., equity should be an important part. But yes, how you invest, what's your strategy, given the valuations, needs to be calibrated, and you should do it in a staggered manner. So I think equity plus some real assets should form a larger part of the portfolio.
Brilliant, amazing insights. And the way you brought down the discussion from an absolute macro level to what an investor can learn and do to create a good portfolio. Amazing insights, and thank you so much for this point that you brought out.
Thank you so much.
It was a lot beyond what we had actually expected to cover in this short interview, because it's a topic that not too many people talk about, and that's what we thought. Thank you so much once again for your time.
Pleasure, Amit.
And thanks everybody for watching this. Keep watching this for our next editions. Thank you.
Thank you. This is a great initiative done by the team. The Horizon Videozine, I think, covers a lot of interesting topics in different formats. Will be entertaining, will be interesting, and it will also arouse the curiosity for all the viewers to know more about the financial markets.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.